Hello and welcome back to Equity, TechCrunch's venture-focused podcast. I'm TechCrunch reporter Kate Clark, and I'm joined by my co-host, free agent Alex Wilhelm. How's it going, Alex?
I don't think journalists can be free agents. I think we can be unemployed.
Freelancer.
No,
how about that?
Not doing that either. I'm moving. That's what I'm doing right now. So I'm employed by taking care of my own stuff, which is not great. But we have some news about that, though. People have been asking us about equity, and
people are concerned about the future of equity.
Yes. Well, we have good news. We have very good news, which is that nothing is changing. So if
nothing is changing for now.
Yeah. Well, no, not even looking into the future. Like things should persist roughly as they have been. So if you like the show as it is, great. If you were hoping that I was going to leave, tough, because I'm not.
I can't do it alone, guys. I can't do it alone.
I mean, the show is coming up on its third birthday, which is, I'm legitimately impressed that we're here. And you just tweeted out a data point, Kate. What was that metric you had?
Yeah, so our downloads increased 100% this year. That's amazing. We don't share exact numbers there, but things are growing really fast, and we're really happy with how this whole year has gone.
We can give a range. It was in the 7 figures. There you go. Enjoy that.
But yeah, I think I've been doing the show now for almost a year, maybe about a year now.
Well, you joined and then downloads doubled. So there you go.
Yeah, I wasn't trying to say that. It sounded like I was.
you
I am responsible for all growth.
Yeah. Anyways, welcome to the Thanksgiving edition of Equity.
Happy Thanksgiving to everyone listening.
It's Wednesday, so we hope you guys are all gearing up with your family and your food and your friends and your fun and your football. Go Eagles! And I don't know. I'm excited about not working a little bit more and all that good stuff. But there's a lot to get through.
So wait, do all teams play on Thanksgiving or just some teams?
I know there are at least 3 football games on Thanksgiving. So if
Go Seahawks. That's the only team I support. Are they playing?
The Seahawks. Well, they beat the Eagles, if I recall correctly, which is ridiculous. And the Seahawks beat the 49ers, which is the only team I think to beat them this season.
Go Hawks.
So,
all right.
Yeah, let's go ahead.
On to things that I actually know about.
This is fun. So we're starting off with the Weekend Fund and the second iteration of this. This is a venture capital fund put together by the infamous / notorious / very nice Ryan Hoover, most famous for his work, I think, at Product Hunt.
Yeah.
Which was a, I don't know, dig / Reddit / what's new kind of like hot list to find.
Product discovery platform. That's how I described it in my story. But yeah, Ryan Hoover's the founder and CEO of Product Hunt, which was acquired by AngelList in 2016 for $20 million. He stayed on. They operated independently. He stayed on in his role, but he also kind of shifted his focus around that time to venture capital with a $3 million debut angel fund that he closed in 2017. Fast forward 2 more years, he's on to his second fund after investing in a bunch of interesting companies like Girlboss, which I think most people are familiar with. It's sort of like a LinkedIn for women.
Sophia Amoroso.
Yes.
She did. She was in fashion before.
She had the company called Nasty Gal.
Mm-hmm.
There's a TV show about that, which is on Netflix. It's a good show. Actually, it's a really crappy show, but it's...
I'm glad you told me. I would have watched it because I read her book and I thought it was very good.
I read her book too. The show was canceled after 1 season. If you're into like kind of crummy shows about young women, like I tend to watch, it's enjoyable, but anyways, not critically acclaimed.
The book though is worth reading, I found.
Yeah, the book she has an interesting story for sure. Yeah. But anyways, that's one of his portfolio companies. TTYL is another one of his portfolio companies, which is like as far as I understand, it's a social media platform of sorts that's focused on audio. So kind of an interesting thing. Yeah, I mean,
that's cool, actually.
It's really cool. And it's an interesting site. I was looking at it yesterday a little bit. And Headspin, which is another one of his companies. This is a mobile application performance software company, pretty highly valued already. I think like $500-600 million valuation. So he's got, a large portfolio of several companies that I recognize. I'm sure that you would too. Doing well enough that he's on to his second fund, which is $10 million. And limited partners in the fund, basically a ton of really famous VCs, Mark Andreessen, Chris Dixon, Jana Messerschmidt, Ben Rubin, Chris Sacca, Hunter Walk. I mean, the list goes on, as well as a bunch of entrepreneurs, founders.
So it's kind of like all the cool kids put money in this fund. And here's a question I have about this, because that is a hilarious number of LPs who all wrote $100,000, $200,000 checks. So essentially not much money to them. Mark Andreessen wouldn't miss
tiny bit of
$100K.
money for them. And I think I read in Ryan Hoover's blog post that he'd written that there was like 100 LPs. Basically, his might have been more. He said the reason he did this was that there would be a ton of advisors for his companies. Certainly could be the case. Could also be the case that he was only getting a little bit from each of them and he had to raise from a bunch of LPs to fill the fund. But more likely, because he has a good reputation, he is well known, as you said. More likely, he really did want sort of all these expertise kind of surrounding the fund, able to help with various companies.
I was looking at kind of the other perspective, though, kind of in reverse, which is these LPs are often people who are either looking for new opportunities to build things or new opportunities to invest. So in a sense, he's kind of doing a scout type effort for them. Like scouts, if you don't know, are people associated with a large fund, say Sequoia, and they have access to some small amount of capital, and they can go out and write these really early stage checks without getting the kind of the big corporate name involved. And so if you get visibility into what Ryan's doing, he does have a good eye for what's hot, what's next, and so forth. It strikes me as a very reasonable place to put money.
Yeah, I think it's one of the big trends that we've noticed, and we've talked about it before. I don't remember why we talked about it, but there are these entrepreneurs, they're well connected, they're almost like pawns for these larger funds. And I don't mean that in a bad way, but like they get funding from other VCs who work at like Sequoia or Lightspeed or Benchmark or whatever it might be, and they use them to get into hot deals. We talked about it when we talked about Superhuman. Because the founder of Superhuman was potentially raising a fund. He was backed, or he's really, really in with the Andreessen Horowitz guys. I think it's sort of like maybe they're using him to get in on some of these early stage deals. Not that these companies don't want to work with Andreessen, but I guess it's just sort of like getting more people out there and
Andreessen can't put a lot of time into a $200,000 check. And so if you need someone who can do that, you just cut off a chunk of the money and, essentially federate it out. I think Indie.vc just announced a bunch of new scouts as well.
A ton of them.
Ashley Mayer, now Glossier, formerly of Box. And I saw, it made me on my Twitter feed feel really, really Silicon Valley based when like multiple people were like, I'm a scout now. And I'm like, crap, at the same time.
Yeah, I was just coming back from vacation, or I was like maybe on my last day of vacation when I saw that news. But I didn't actually see the news of what was happening, but I just kept seeing all these tweets that were like, I'm a scout. And I was like, what? Why is everyone all of a sudden a scout for IndieVC? But that's because there was a big announcement.
Also, when I was growing up, being a scout wasn't very cool. I meant you were in Boy Scouts, and now it's like the coolest thing in Silicon Valley.
Terms
have changed.
It's pretty cool because like if you're a CEO of a company, like I met with this one really awesome CEO of, I can't remember the name, but it's a med tech sort of thing. And she was a scout for Sequoia. And she was just saying, she's like, every so often I meet a really cool company and I basically just shoot them a note being like, hey, this is cool, you should invest. And then if they agree, they do. And then she gets I don't know whether it's just a check right then or it's a cut of the company or whatever it is, but it's a pretty nice setup because it doesn't require really her to do any work. She's just existing and going about her day. And she comes into contact with these companies because, of course, she does. She's in that ecosystem.
Yeah.
So it's a pretty sweet deal, I think.
It's like an early earthquake detection system for cool companies that might change the game. And I think everyone's looking to get in early, as early as possible on whatever's going to be the next big thing. And then they want to just foie gras it with money. Last thing on this really quick, we have seen a lot of funds get larger over time. Another example of that, this is a much larger fund. We've also seen not every fund that starts off with a small amount of capital make it to a second iteration. So we presume Ryan was doing a little bit better than most. And I think I would call this a nano fund. Kate, back to our discussion about nomenclature.
We talked about this before we taped because I was reading an article in Crunchbase News about small funds, essentially. And they differentiated between a sub $25 million fund and a sub $100 million fund. So a sub $25 million fund is a nano fund. So I had never heard this term, but I like it because it helps you be really specific about what it is you're covering. Yep. Sub $100 million fund, so probably between 25 and 100 million, that's a micro fund. So I'm someone who typically just says micro fund referring to all of those, but like if you want to be really specific, you can differentiate between nano and micro. So maybe I'll try to do that from now on to be more clear.
It's helpful. I used to make fun of the idea of pre-seed. Like, isn't pre-seed just seed? But I've also realized
it helps.
Yeah, it does help. So more striations, the better. Let's move on to a failure. Actually, we don't talk about too many of these on the show since kind of the Blue Apron days, really. But Omni is shutting down, to my understanding, and effectively selling off its engineering team to Coinbase, a kind of giant in the American crypto space. Always, I presume, hungry for engineering talent. The reason why this is pretty interesting is that Omni had raised $35 million. So this was a relatively well-backed company. This wasn't just a YC company that kind of flamed out. That happens a lot. So
no,
what?
it raised quite a bit.
Yeah. Omni, to my understanding, was a neat way to get stuff out of your house and into storage. And the company would then kind of catalog and tag things. And then you had the ability to rent out certain items from your personal collection of stuff. And then you could also have it brought back to you. And Kate, as I explained this, it seems kind of too complicated to work.
There's a lot of moving parts. And I wasn't particularly familiar with this company until all this news of it shutting down. But now that I have learned a bit about it, I'm not surprised that it didn't work out. So, you have companies like Clutter, which will store your stuff for you, which is great because, millennials in particular, apparently moving around a lot, whatever it might be, they need to store their stuff.
Literally me this morning with the van.
Yeah. But Omni took it a step further than a company like Clutter by actually letting you or allowing them to then rent out your stuff so that you could make money while you were storing your stuff. So it's kind of like, it's a strange combination of a lot of things. I don't know why they felt, to take that extra step toward actually renting out your items as well. But I think somewhere along the way that just became too complicated for them to sustain.
Yeah, and I think they had kind of shut down their operations earlier and tried to white label their software. And I just think they couldn't find something that was going to work out for them long term. We're going to see more of these over time as we get later and later into this kind of startup cycle. But I think anything that raises over 20 million and shuts down is probably worth a mention if we become aware of if it's kind of end of life is rapid as opposed to a long, slow decline. We should bring it up and talk about it.
So Omni raised $25 million, part of that $35 million, from cryptocurrency company Ripple in early 2018. And now they're now 10 of their engineers are going to Coinbase. This is hopefully not a really stupid question, but what is the crypto connection here that I'm missing?
Well, I didn't know that their capital had come from Ripple, which is XRP, which is one of the most valuable cryptocurrencies, if you didn't know that.
So are they built on the blockchain or something? What am I missing?
Well, then we can't make fun of them. I was trying to be very sympathetic because they worked really hard at a hard idea and took a real shot at it. And, good job. Entrepreneurship matters for the future health of our economy. But if it was a blockchain play, I must have missed that when I was prepping for the show today. My mistake.
I'm not seeing blockchain in any of these articles. Yeah, and Chris is shaking his head. Why?
Because I was confused why they were going to Coinbase.
Yeah.
How come whenever...
Someone tell us, please.
Whenever blockchain comes in, I feel like you and I just kind of sit back in our chairs crap.
Don't ask me about blockchain, please.
It's a slow database, but you can't change it. It's great.
Decentralized.
Yes, there you go. Censorship proof. And in this case, also didn't say it's a business model. We have seen a lot of layoffs lately. We talked about this on the show. Fair, WeWork, Uber, etc. We'll also be tracking the shutdowns as we track the capital raises.
That is true. At my last job, we used to do an annual collection of, we had a big list of every single VC-backed startup that shut down, and we did this thing called Startup Graveyard. And looking back, it was kind of like dark and probably like too mean. But since I did that at my last job, I was always kind of like familiar with and keeping track, but I don't do that anymore. And it feels to me like there's been actually way less companies shutting down. It's probably just because I'm not keeping a close eye like I used to. But I don't know, do you feel like 2019 there were fewer startup casualties?
There's been so much money around. I don't think we've had this cold snap that then freezes everyone in place, and then there's all these problems. I mean, you and I read the same story from the Wall Street Journal in the last 12, 24 hours that was discussing how the sentiment in the market has changed and everyone's really worried now in this post-WeWork, situation. But everyone that I talk to still seems pretty enthusiastic. And so I have yet to see the sort of sentiment shift and then changing investment patterns that would kill off a lot of companies mid-cycle.
Yeah, as much as everyone still talks about the downturn, we're yet to really see symptoms of it yet. And I think because of that, people are still sort of throwing money around, but maybe 2020 that will change. I mean, hopefully not. Obviously, we're not advocating for companies to shut down. I'm just thinking, talking about Omni, that it feels like we've discussed a lot fewer of those, recently than we may have.
Yeah, but now that our antenna is up, I mean, I'm sure we'll now see more of them. But I think they have been drowned out by the enormous, like Company X raises $100 million round from some random investor, like I don't know, name somebody. That's always going to grab my eye more than small company who I hadn't used in 4 years shut down.
Right, certainly. All right, shall we move on?
Yeah, do you want to talk about Cocoon?
Yeah, so this week a company launched, finally. This was a company that we saw at YC Demo Day. Let's see, not the last batch, so not summer. spring 2019. The company's called Cocoon, and I couldn't talk about it because they were one of those companies that was off the record at demo day, which means that they do a presentation, but they give you a little piece of paper that says off the record, and you just can't talk about it at all ever again until they come out, which they did this week, and they tweeted that they are now officially available in the App Store. Do you want to describe the app?
So I went ahead and played with this before, actually over the last couple of days. It reminded me a little bit of Path and a little bit of kind of like, remember the circles in Google Plus? We could kind of like have people in little buckets.
Yeah.
So I started a Cocoon, and you can share images and kind of facets about your life, like how much battery life you have left in your cell phone, and kind of all these things, location, I think, as well. And it's an idea that privacy and kind of like personal intimacy with you and like a certain cohort of friends is something that's really, really important. I agree with that. The app seemed really, honestly well designed.
It did seem really well designed. I agree.
Yeah, by two ex-Facebook people, so they know what they're doing.
Yeah.
And they've raised $3 million from a venture capital firm called
Rare Hippo.
There you go. Because I mispronounced that apparently in the pre-show, and I was mocked.
At least
mercilessly.
I think he mispronounced it. I might be mispronouncing it, but Alex said Rare Hippo.
Did I say Hippo?
It's like you say Yahoo, or what do you say? Yahoo.
Yahoo.
No, that's not how you say it.
Yeah.
You normally say Yahoo, I think.
Yay. I don't say Yahoo. That's an exaggeration. Anyways, they got $3 million, and they came out this week. So I'm positive about it.
Yeah, I think it's interesting. I remember their pitch, and I remember that was a company where I was like, darn, I wish they weren't off the record because I actually think this is really cool. They had a really good pitch. They're obviously really experienced. It's, if you've used Life 360, it's definitely similar, and I use that with my family. So I was intrigued by the possibility of sort of maybe switching over. Cocoon is much better designed, and I think, as we talked about before the show, Life 360 is something that a lot of teenagers are forced upon by their parents so they can get better, so their parents can GPS track them. And my mom still GPS tracks me, so I understand.
Can we pause and just, what is like the short explanation of what Life 360 is? My parents are 67 and text me, but that's kind of the extent of it. So
it's an app that, you can track people on it. So there's a big map, which I like to use. You can see where all your family members are at any given time. It also tells you things like what their battery charge is, which I always find funny because occasionally, like, my younger brother will be like, Kate, you need to charge your phone.
It's like pipe down, go get your own life.
Stop. But I don't know, honestly, I think there are many other features, but that's kind of how I use it. Essentially just a way to communicate with your family and keep track of them. But like I said, Cocoon is better designed. So I think those teenagers that are currently forced to use Life 360 may be more interested in using Cocoon just because it looks cooler. And it does. Life 360 looks like it was designed by helicopter parents. Oh. I don't know who designed it. I mean, the company, obviously, but I don't know who's behind it specifically, but it's it gives off sort of an uncool
parent down
vibe.
Kind of like forced use thing.
Yeah.
Are there a lot of apps out there for parents to kind of surveil their children?
Yeah, I think so.
Wow.
Life 360, I think, is a common one. The thing is, though, you can share your location in iMessage, and that's how I have a few friends, and a couple siblings who I do that with, and that's the easiest. I wish my mom understood that, but she doesn't. So
we have very different siblings. I'm just realizing this well. My siblings, if I text my brother and I get a text back within a week, that's like, oh, he's alive. Great. Fantastic.
Yeah, we're pretty communicative in my family.
Treasure that, because I wish my family was more talkative at times, and they're not. Anyways, enough talking about our families. Sorry for bringing that up.
It is Thanksgiving week, to be fair, and I'm not seeing my family this week. So
really?
No, because I'm going home for Christmas, and I'm going to Germany next week for TechCrunch Berlin. So I can't just hop over to. Why are you looking at me like that?
I forgot TC Berlin was next week.
Well, it's the following, but I'm leaving next Thursday.
Oh, okay. My gosh. That's so soon.
There's a lot happening. And I just got back from TechCrunch Shenzhen, so I'm kind of
Yeah, how was China?
It was good. We were actually going to talk about it, but we didn't.
Yeah. So
it was cool. Yeah, so I interviewed the CTO of Lime. She said, I think between 6 and 8 times in the interview that Lime would be profitable next year. So please, we need to hold them to that. Because I was like, really? You really are? And she was like, we will be profitable.
Okay. Profitable in what terms? Like adjusted EBITDA?
Legitimately profitable.
Like GAAP net income?
Yes.
Wow.
Yes.
I mean, I want that to be true.
She said it over and over again. So anyways, I would like to hold them to that. I think she said second half of next year.
So there'll be, not a full year result, an H2 20 result.
H2 20%. Yes. And no, full year next year. So she said that, so Lime's, you remember, I think it was the information, they published a story about Lime's losses. We talked about it.
Oh, yeah.
So apparently Lime's losses were pretty bad 1H this year. Second half, she insinuated they did wonderfully. So she said next year full year profitability. So I think, I don't think that it will happen, but that's what she said. So
it would be a revolution in the micro mobility space if one of these companies even turned an adjusted profit for a material period of time while growing. If Lime can pull off actual net income over a multi-quarter period, well, I think I'll have to eat my shoes. I mean, and more power to him for having it right and us being...
Headline for the episode, Alex will eat his shoes if Lime does not become profitable in 2020.
I once bet Jason Limkin about eating a hat, and then I think one of us lost the bet, and so we had a hat-shaped cake made, but that was my way out of that.
That's funny. Scooter cake.
A scooter cake? Well, we'd have to actually make a scooter cake. Do we know a bakery that could actually make one?
No.
Probably not.
You should ask Megan. She'd probably know.
She would.
So yes, I talked to her about Lime, and it was interesting because she used to work at Pinterest. So her entire background is yes, in engineering, but software. And she's now in hardware, and she's kind of said like it's been really interesting, and she seemed really confident, like she's really managed to transition from software to hardware pretty easily. But it was great, and I talked to a bunch of VCs and met a whole bunch of cool people. It was a very successful, very well attended event. So I'm excited for Berlin, which should be awesome. So
one last question about China, and then I want to move on to Airbnb. But we have seen the Chinese venture community dramatically pull back in terms of how much money they invest at the late stage. And according to the numbers I saw before I left Crunchbase, it was actually slowing down, I believe, also in the kind of the middle and early stages. Did that get discussed at the event? Were people talking about this cliff that venture dollars in China had kind of run over and slowed down?
No, I think there wasn't, how should I put this? I don't think people at the event felt that they could be completely, what's the word I'm looking for?
Honest?
Yeah.
Upfront, clear.
Like
transparent?
Yeah, I mean, opinionated, sharing, kind of off the cuff, sort of. I don't think people felt they could be very like, it seemed to me that people were really thinking about what they were saying and being very careful.
Okay.
So when it came to things relating to China, being in China, I think people were careful. So is what I'm saying. Of course, other like subjects equity. Less. But what?
I was joking that that's not like this show at all.
Right. Yeah, we aren't thinking through anything that we're saying. just saying things. The first thing that pops into our head.
Mostly just having fun.
So yes.
I'm not surprised to hear that, but I wouldn't have guessed that. But I'm not shocked now that you've told me.
Yeah, I mean, it's always interesting going over there. And I think given, I went last year as well. I think it was a bit more free-flowing. This year felt a little more tense. People were, like I said, being a little bit more careful with what they said. And when it came to speaking about China in particular, I think, people avoided it. I asked, the CTO of Lime why Lime wasn't in China. And there wasn't really a straightforward answer to it. It was more like, one day maybe we'll be here.
It's a huge market, super exciting. We got to get the mechanics right, and then maybe,
Yeah, there you go.
You can always kind of just
speak.
Yeah, you just kind of throw a lot of that at the problem. Yeah. Anyways, let's move on. Two more things to get through today. The first of which is that Airbnb, a company that we expect to direct list, I would say
Q1.
I was going to say Q2, but Q1 sounds great. I'll take a Q1 direct listing.
I think they just need to get it done before there's more drama.
As long as they don't kind of form a bit of the next drama, because the numbers out from the information, which has been, honestly, to their credit, really on the Airbnb story the last 6-9 months, reported that they actually had a $100 million, I believe it's adjusted EBITDA loss in Q2 of this year, which comes after a sharper, I think it was $306 million adjusted EBITDA loss in Q1. So they had an incredibly unprofitable kind of first half of the year. Keep in mind that adjusted EBITDA is a politely, massaged profit metric. It's not as strict as GAAP net income, which is why when Kate said that about Lime, I was so intrigued. So we can presume that they lost more money than that on a GAAP basis. We don't know the cash flow side of that, so we only have one window into the company. But their growth was slowing. I think it was 34% in Q2 and 33% for the first half of the year, and they did revenue of $1.2 billion in Q2 itself. So
what's the I didn't read the story, but did they have any sense of what's driving these losses?
Yeah, it's an incredible growth in sales and marketing. Other costs are going up as well, to be clear, but that seems to be the driving kind of pulse.
Well, so we already talked about this on the podcast, but there was that very good story in Vice about the person who accidentally uncovered a nationwide Airbnb scam. Yeah. So there's been a lot of things like that. There was also the very tragic shooting on Halloween or around Halloween in an Airbnb property. So Airbnb is now doing a whole bunch to actually verify their listings, which is great and needed to happen and probably should have happened a while ago. But these things will cost money because it requires employees to actually, physically or, examine thousands of photos of properties and whatever it may be. So that's going to be costly. So I'm curious going into next year how their finances will look, or, perhaps even closing up Q4, how that might be impacted.
Well, just thinking this out loud, those costs that you're outlining would be effectively a cost of revenue to me. That wouldn't be a strict sales and marketing expense. So you can see possible gross margin erosion at Airbnb, but we haven't seen the numbers. We don't know how the accounting works out. We haven't seen what the SEC has approved. We're thinking if that is the case, Airbnb could see itself slip a little bit from the technology bucket into the technology-enabled bucket that Omni, for example, was in. Now, Airbnb is doing fine. They're not in any trouble of being shut down, but it could impact their revenue multiple at the time of their direct listing, which could make it more difficult to hit the numbers that they expect. But at the same time, growing by a third year over year when you're doing, $2.5 billion, whatever that is, in H1 revenue, you're huge. You're doing great. So I can't really throw a lot of stones.
No, I don't think so.
But the losses aren't good news.
Right. I mean, this is what we do is we talk about things like this. So that's why we're talking about it. We're not throwing any stones. I mean, I think Airbnb is going to have a very successful exit. I think we both said they seem like a great company. They, certainly the narrative here is much stronger and more enticing than a lot of the other Silicon Valley unicorns that have either gone public or considered it, or WeWork.
Well, I mean, WeWork being the obvious counterexample to everybody, but I mean, for the last couple of years, the thing that we kept hearing was Airbnb is doing better than you think, and everyone thought it was doing pretty good in terms of scale and profitability, because last year in Q2 it made money.
Yeah.
So
I wonder though when they finally reveal their S1, and of course, expose their finances, if we'll be disappointed, because now our expectations are really high, because for so long people have been like, they're doing better than you think, and we're maybe thinking they're doing better than they are.
We're getting the numbers. I mean, remember back when we got like the WeWork numbers for 2018 and they had lost 1.9 billion on revenue of 1.8, and we were all like, wait,
freaked out.
Like what? Yeah. Is that supposed to be what's supposed to be?
Is that number correct? Yeah, that was frightening.
Yeah, and it turns out that was a bad number. Now in this case though, obviously reasonable growth, reasonable losses, probably reasonable cash spent. The question is, what number do they want to hit? And if it's a really high number, will they reach it, or will it be disappointment there in pricing?
I wish that Airbnb would drop their S1 in December, because December is a really boring news month. And I was just thinking today, I was like, if Airbnb would drop their S1, that would give me something to do for like 2 weeks of December.
Airbnb's COO is leaving the company. Belinda Johnson is stepping down as COO in March. I bring this up because I'm curious if that impacts the direct listing timeline. Don't know. But
so she said that she wanted to spend more time with her family.
Yeah, but that doesn't mean anything.
No, it doesn't. I agree. I was, why is she leaving right before the IPO?
Or right after is my question. If you drop an S1 in December, you can DL in January.
Oh, she's stepping down in March. Okay. Yeah, so I didn't realize. All right.
Your timing would put the IPO inside of her tenure, which would make some sense to me. But if the DL is in June, that would be kind of strange. Like, why not stick around for the big event that you've been working so hard for?
It reminds me of when Julie of Stitch Fix. So she stepped down in like 2017, like exact same, like 3 months before they went public. And everybody was like, why would she leave? It's because she was building her own business. And then that actually I wrote about it like 3 weeks ago. It only just came out as public. So 2 years go by. The whole time she's building a company. It's called The Yes, I think. Anyways, that's just an example.
What does it do?
It's going to be a next generation, really, AI shopping platform.
Don't we already have like 20 of those?
It's going to be like the real deal. And I'm actually not kidding. She's just the top of her field. She's worked at like Sephora, Nordstrom. She like built so much of Stitch Fix. She's just like the expert in e-commerce, next gen retail. And she's working with this AI expert. I think it'll be interesting.
Cool.
I don't
No, I'm
really
here
know
for
if it's I think we probably talked about it. Anyways,
The yes?
maybe we didn't.
I don't think so. But it sounds if
I
they
hope
can
that's the
actually make
name.
it. If it's not, this segment's going to seem
Julie
really
Bornstein
strange.
is her name.
Okay.
Okay. Anyways, maybe Belinda Johnson is maybe it's something like that, or maybe she's found a really awesome next opportunity. Maybe she does want to spend some time with her family. We don't really know.
I mean,
we have no idea.
Family time is a good time. Let's wrap with something that we're working to understand. I think it's a fair way of saying that.
So the New York Stock Exchange filed paperwork with the SEC this morning, and they want to change the way that direct listings works, which is really interesting because direct listings is something we've talked about all year long, particularly in the last few months. So the proposed change would actually allow companies to raise money through a direct listing. So as we've said, direct listings are a way to go public, but you only sell existing shares. So shares held by employees or insiders, and you don't raise any new money. If you go public via an initial public offering or an IPO, you issue new shares and therefore raise new money. So by allowing companies who are choosing direct listings to actually raise new money, it's kind of like the best of both worlds, which is why we're a little bit confused as to how it actually is different from an IPO.
Yeah. So we read through the SEC filing this morning, and we began to frantically talk to our friends and sources who know this stuff better than us. I didn't get to complete confidence, but here's the way that I would kind of frame this. And we're going to talk about this, I'm sure, ad nauseum for the next while. So we will figure this out and we will explain to everyone in more concrete terms. But in between a direct listing and a traditional underwritten bank priced IPO, there may be a middle ground that allows the company in question going public to have more control over how many shares they sell and at what price, which would undercut the argument that Bill Gurley et al. Have been making, forever now about mispricing of IPOs and that sort of risk. So probably the NYSE doesn't want to lose all of its offerings to the future long-term stock exchange, if that ever kind of comes into the fore, as people expect that it will. So this, to me, seems like a bit of future-proofing of a key index against a trend inside a critical sector that are trying to buck the traditional ways that it has made money for so long. Yeah,
so two things. One, I'm guessing the NASDAQ will follow suit with this. Two, so Bill Gurley has been, the guy chatting about direct listings all year long. He's a big fan, as are many other VCs, because there are a bunch of reasons why. One of them is because of market-driven price discovery. So the concept of taking that power away from bankers who are notoriously bad at pricing IPOs, and probably for their own benefit because they often get these big paydays if they, whatever it might be. So if you are, if we go toward this route of a direct listing where you can also raise money, but there's market-driven price discovery, so there's actually there's a lot more power in the hands of the companies to actually determine the price, whereas you're not just letting some bankers be like, let's price it at $12 a share, and then it opens at $42 a share,
right? Or
it opens at $1 a share, and you're like, why did you price it at $12 a share? So that's certainly one of the greatest upsides of this. So I can't really see why, or what do you think? Why would a company not go public through a direct listing if they can also raise money?
So I have a lot of thoughts about this. When we're not going to go through them all today, we want to let people go see their families and not just worry about the arcana of the SEC. But when you direct list, the argument that I've been told is that even if you need more money, a direct listing is fine because you should just raise a chunk of private capital and then go through a direct listing, which is kind of okay, but you're still doing a price discovery round right before you direct list. You're still being priced. Now, this only makes sense as an argument if you think you're going to get much better terms from the private investors than the public investors, which is fine, but it sets up an automatic, to me, imbalance between the expectations of the private investors and the kind of implied sentiment of the public markets. So to me, it still doesn't quite solve the issue. What would is, being profitable, but,
there are a lot of options at this point. So
it's good for entrepreneurs. It's good for VCs. I think the old traditional IPO is imperfect, but slightly over maligned. But I think right now there's so much money, people can afford to push back against kind of a outdated method of pricing.
And we also recorded a special episode of Equity covering the topic of direct listings with an expert on the subject. So that will be available next month. So you guys should look forward to that excellent dive.
Cool. Well, we should wrap up. It is a holiday week, and we should go forth and do other things but talk about finance. But we'll be back at the regular time next week.
Yes.
And you will be back from Berlin when?
Probably December 15th. I don't know.
All right, well, we will figure the rest of that stuff out later.
That doesn't matter to anyone listening. So.
Well, happy holidays, everybody, and Equity will be back soon.
Happy Thanksgiving.
Bye.